So, hello, students, and let us continue with the third chapter, which is going to talk about accounting principles. So, let's understand why is this chapter there and what is it going to tell us. In short, this chapter is going to talk about some rules. It's going to talk about some principles. It's going to talk about some concepts and some conventions. So, what are all these things and why are they there at any particular time? So rules are there so that everyone abides with them and so that everything seems systematic. Principles, concepts, conventions can also be thought in terms of the same. So these all, if we have even in the accounting subject, then things will be more organized. Things will, whatever will be shared between the business and the users of that information, that all will have some consistency. So that's the reason for maintaining some rules or principles or concepts or some conventions in accounting. That's the reason for making them. So in accounting, these rules and concepts, these have certain features. So the first of them we can talk about what are some features of these accounting principles. The first we can say is that these are man-made. What do we understand by such a statement? Being man-made, it means that we have, or there is some body which is under the Institute of Chartered Accountants, which has prepared such accounting principles or rules which are supposed to be followed. This keeps everyone on the same basis of accounting, in the sense that everyone will follow what is prescribed, and therefore their accounting can be compared with one another later on. So, these being man made, these are not obtained in nature, but actually have to be set in place. That's what it is meaning. So, they are man made. They don't appear by themselves in nature and are formed by humans to keep accounting uniform. Okay. The second feature is that they are flexible. Now, what do we understand by the term flexible? This means that they can be bent. And by that, I mean they can be modified. So they are flexible means these rules or these principles of accounting are capable of being modified as and when required. So it's nothing like it has to be as it is once mentioned. It could be changed. And that is what this principle is saying. This feature of accounting principle is saying. The third is They are generally accepted. When we say generally accepted, this means that it is something in common for all those people who are doing accounting. So they are generally accepted by everybody. And to do such a thing, to be generally accepted, they follow certain three criterias. The first is relevance. So here we can say they are generally accepted because they follow or they conform to certain criterias. And which are those criterias? The first is relevance. So under relevance, we can say accounting is relevant because all that is shown in accounting is based on what happens in a business in the current year. So we mean through this that everything that is shown in our accounting is generally accepted. Why? The reason for them is because they follow three criteria. The first is that it is relevant. And by relevant, it means that all that is written down in accounting is belonging to that particular year under consideration. All that has happened in that business in the particular year, all that is recorded. The second point, which we can say, is objectivity, the second criteria. So accounting is objective. This means that there is no bias. Bias means favoritism. So when accounting is done, there is no favoritism. Everything that is happening is going to be recorded. There's not going to be anything that is going to be left out if it has happened in that particular year. And another thing to note is this saying that there is no bias. This is verified by certain verifiable documents. And which are these verifiable documents? Example, an invoice, a sale bill, etc. So everything that is supposed to be written down in accounting is verified, is objective, there is no bias, and it is generally accepted because of this second reason. Another point which we can talk about is feasibility. So the third criteria which is met when it is generally accepted is that it is feasible. So by feasible, we mean capable to be done. So accounting is said to be feasible. Accounting is said to be feasible because it talks about only what has been transacted in a business. Okay, so accounting is said to be feasible because it talks about only what has been transacted in a business. It doesn't talk about anything which has not happened in a business. All those things which, all those business transactions which actually occur in a business, those are the ones which are being spoken about. So, this is the third criteria which is met. Now, what is the usefulness of having such accounting principles in place? As I said earlier, having all this in place means that we have some very important aspect fulfilled through accounting. So accounting principles, when followed, maintains uniformity. This is one of the most important aspect as to why we follow accounting principles. Uniformity so that every accountant, or you can say business, is capable of understanding the information conveyed. Okay. So accounting principles, when followed, maintain uniformity so that every accountant or every business is capable of understanding the information conveyed. So this is why we follow accounting principles. This is like the heart and soul of why accounting principles are being followed everywhere throughout the world. And it is prescribed, or there is some body which is governing this. So in India, we have the Institute of Chartered Accountants of India, which prescribes such accounting principles for us to follow, and so on and so forth. So wherever you are, it depends on which principles will be followed. And normally, these are the ones which are followed throughout the world, and they are generally accepted. When we say generally accepted, there is a term which is GAAP. So this stands for generally accepted accounting principles. Okay, so this is one of those terms which are there, which you can go through also. Now let's talk about what are these principles and what do we start from? What principles must everyone follow? Or what concepts? Basically, you call these as some concepts which are supposed to be followed by every account on default, by default. So, accounting concepts. Now we have three accounting concepts. The first is going concern. Okay, now what does this mean? Going concern. So by going concern, we mean it is a concern. A concern, and a concern can also be thought of as a business concern. So a business concern, which is going on and on and on and on and on. So a business concern going on for a long period of time. This means that there is no ending of this business. Whatever I'm talking about, the business or the concern is supposed to go on and on and on. It's not supposed to end. So this concept says a business will continue to exist in the future, and there is no intention to close down the business. So this is what this concept is. A business will continue to exist in the future, and there is no intention to close down this business. This means that whatever business we start off with, it's supposed to continue with no intention to close it down. Now, this will have some significance due to such a statement that we are passing. The first thing is that if it's going to continue to exist, then we will think of all our assets in terms that they are going to continue to be there. Therefore, as we classify assets as being current and non current, this is the right. We classify assets as current assets and non current assets. And this is correct because we are following this concept. We are following this concept saying that a business is going to continue to exist because current assets are those assets which are for less than 1 year. Non current assets with us are for the time period which are more than 1 year. So if we have something already in place that a business is going to continue to exist for a long period of time, that is when we will distinguish between these two kinds of assets. If not, it doesn't make sense talking about two types of assets. We do not have any significance if we don't consider a business continuing to exist for a long period of time. Okay. Another important point which we can think about in this is we take loans. We take loans from certain people. We take loans. These loans, we say we are going to repay them. Loans taken are to be repaid. Now, if we take them, let's say we are the business. So we are here. This is us. We are the business. And we have taken a loan. The loan is of 1 lakh. If we say that this business is going to get over within a year, then there is no significance of taking this loan when we are saying we are going to pay it after 1 year. So we mustn't start the business considering that we are going to close this business by the end of the first year. Because if we have decided this beforehand, then it makes no sense in taking a loan. Nobody will give us a loan for the first place. Nobody will give us a loan because we are closing down our business within a year. So it is because we are not considering that our business is going to close down. Therefore, we get a loan. So this is another point which we can take from this as a conclusion of following the principle of going concern. We have more examples. We can talk about prepaid expenses. Prepaid expenses are those expenses which we have paid for in advance, and the benefit is going to be obtained in the near future. So prepaid expenses are done to take benefit in future. So if we have some expense that we've paid for beforehand, and we know that our business is going to close up maybe within a year or maybe within half a year, then doing such an expense as a prepaid expense makes no sense. So this is one more reason why we consider our business to continue for a long period of time. Next, let's come to the next concept. The next concept is consistency. So where do we have to be consistent? This concept is saying we have to be consistent, but where? That's my question. So let's understand that. So consistency, basically, if we talk of this term, it means we have to follow the same thing again and again. We have to be adhering to that same kind of a practice which we are doing. So in business, the business for the first year, for the second year, for the third year, and so on and so forth, for the number of years that is continuing to exist. For those many years, it has to follow the same practices, has to follow the same practices. Okay. It cannot change it. There shouldn't be any change in the practices which have been started in a business from 1 year to the next. So therefore, the consistency concept says this concept says that a business must consistently follow the same practices or methods in doing its accounting from 1 year to the next. Now, what kind of practices are we talking about? So, this kind of a practice is like, let's say, There is a chapter which we will study, which will be depreciation. Okay. And within this chapter, there are few ways in which we calculate depreciation of some fixed assets that we have in our business. So the first method is called straight line. Straight line method. The second method which we will study will be written down value method. So whatever you choose in your business, let's say in a business, we have chosen the first method, the straight line method. This is chosen. So every year, this business will charge the depreciation on its fixed assets by this method. It cannot change it. This is possible, though. You can change it for certain reasons. Like, for example, can change if the government says, or if it leads to better presentation of the accounting. So things can change, but only in case of these two reasons. If not, a business is supposed to carry on the same practices and not change them from one year to the next. Okay, this is another example. Why is it saying that we can change it? This there's a reason. I said normally it doesn't change, but at times it may change it. The reason for this is because just now, sometime back, when we were talking about features of accounting principles, there we said that they are flexible. So it will only be flexible if you allow the change, and those changes can take place at certain amounts in time. Let's get to the next one, which is called accrual. This is the third concept. So, what does this mean? First, we will write what this means, and then we will try and understand this. According to this concept, a business transaction is recorded in the books when it takes place. And not when the settlement takes place. So, what does this mean? Let's say we have something which is outstanding with us. Let's say we have some expense. Let's say an outstanding salary. Okay. Now, this is something which I have not paid. It is outstanding. By outstanding, it doesn't mean like it is exceptionally good. Over here, this means that this is something which is not yet paid. It's outstanding. In that sense, we are talking. So, something which is not paid. Let's say on when do we pay salaries? We pay at the end of the month. So, let's say for the month of March 2025, we have not paid the salary for some employees. Now, such a transaction, what do you think? When will it be recorded in my accounting? Such a transaction has to be recorded or no? That's the first question. And when will I record this? When will I write this down in my books of accounts, showing that this is something which is pending to be paid? See, this principle says that a transaction is recorded as and when it takes place. So, if I'm supposed to pay salaries, let's say I'm paying salaries for every month. So, this is for Jan, this is for Feb. But for March, I am saying I'm not paying. Nothing is paid for March. So normally when I pay, what is going to happen? In the month of Jan, some money will go out. That means my cash would decrease. In Feb, my cash would decrease. But in the month of March, I am saying that my cash is not decreasing. My cash is going to remain the same because I'm not paying. So if this is not paid, will I not record this? This is the question. When will I record this otherwise? This is not paid. So will I not record this in my books of accounts? This is what this accrual concept is going to tell us. So this is saying that a transaction is recorded as and when it takes place. In these transactions, which were in the month of Jan, which were in the month of Feb, what must have I done? I must have reduced my cash for each of these months. But in the month of March, I did not reduce my cash because it did not go. So, in order to show that this is going to be an expense for that particular month, I have to show something which is actually going. So I will show that I am paying a salary, but that salary is an outstanding salary. That means it's not that since I'm not paid, I'm not going to show it. I am going to show it, but I'm not going to show it as cash going out. I'm going to show it as a new item in my books of accounts, which is going to show up as an outstanding salary. I'm going to show that this outstanding salary is due to this salary that was supposed to be paid for the month of March. Now, how it is supposed to be paid, all that we will learn in the detailed chapters which come up later. When we talk about journal entries, that is a very specific entry which we'll understand there. For now, just understand that since it is to be paid, it will have to be shown for that particular month, whether it is paid in cash or not. So over here, it is going to be shown and it is going to be shown as a new name, which is outstanding salary. Another way of understanding this, let's see that also. That was the first example. Let's see a different example. Let's say we sell goods. Okay, so we have some goods which we have sold. These goods are costing 10,000. I'm selling these goods to Rohit. Rohit is a person, a business person. So he has bought these goods from me. But Rohit has not paid me the money. He has not paid cash. So in my books, actually what is happening? I am the business. So I'm always going to consider myself as the business. So for me being the business, these goods have gone out. So my goods have reduced by how much? 10,000. But Rohit has not paid me cash. So if cash has not come and some goods have gone, then this is something which is not a complete entry. I have to at least get cash, or I have to at least consider Rohit as someone who is yet to pay me. So since the first criteria is not fulfilled, where I'm saying cash is not received, the second criteria comes into place, where I'm going to consider Rohit as somebody who is going to pay me in the future. So this transaction will be complete and will be recorded in my books of accounts by saying that Rohit is a person who has not paid me cash and has purchased goods on credit. That means somebody who has taken the goods but not yet paid for. And these people are known as, in short, I can write this as a debtor. Okay. Now, will this complete my transaction? Yes, it will complete. Because I cannot leave my transaction with only showing that goods are gone and some cash has not come. So a transaction is recorded as and when it takes place, not when the settlement takes place. By settlement, I mean the cash. Settlement is not done, but I will still record this because I am considering him as a debtor. Okay. Again, I'm saying the actual accounting of this we'll learn a little later. So till then, just keep these in mind as to what is being explained. Okay, so we have done 3 accounting concepts. And each of these concepts, you must remember, these are by default applied. No accountant can say that they were not specifically informed to start considering these accounting concepts. Okay, so this is a very important point. You can mark this important. This says that no accountant can say that they were not told to follow these 3 concepts. These are by default applied. Now we come on to some other concepts. The next will be business entity concept. So the fourth, business entity concept. So this concept says that the owner and the business are 2 different entities. Okay, the business and the owner are 2 different entities. The business also does transactions in its books from its own perspective and not from the perspective of the owner. Okay. So the business also does the transactions in the bank, in the books from its own perspective and not from the perspective of the owner. So we have two different entities in a business. One is the owner, who is also known as the proprietor, and the second is the business. So we have to always consider ourselves as the business. This is what I've been telling from the first day, that we do transactions in terms of the business. Let's consider an example. Let's say the owner brought this business in place. He started this business, and the owner gave 1 lakh to the business. So when the owner gives 1 lakh to the business to start it, this kind of a money, this kind of money which is received by the it is received by the business. So in the business's books, this will be recorded as something which is coming in, and we know what the something is. The something is capital in the form of cash, and both are equal to 1 lakh. Okay. So in this case, capital and cash are both equal to 1 lakh. And this is recorded in the books of the business. Okay. Let's go to the next. Okay. Before we go on to this, as we have also spoken of capital here, we can consider this same example and extend this in order to talk about one concept. When we talk about capital, this business is started with capital of 1 lakh. This capital for the business is a liability. This capital for the business is a liability. Why is it a liability for the business? The reason for that is because the business is supposed to pay it back to the owner. Okay. So for the business, this kind of capital or this kind of a burden, this is also a burden, right? Liability means a burden. So this kind of a burden on the business is there, and it has to pay it back to the owner. For the owner, what is this? Well, the business is going to pay it back something. So this money which is given to the business, this money will be like an asset for it. It's given it to the business. So therefore, it knows that this money is going to come back to it. So it's like a loan which it has provided to the business. And it is in the name of capital. So this is an asset for the business, but a liability. It is an asset for the owner, but a liability for the business. Okay. Next, let's see, which is our next one? Money measurement. Money measurement concept. So this concept says a transaction in business would be recorded only if it is measurable in terms of money. Okay. So a transaction in business could be recorded only if it is measurable in terms of money. Example, some transaction which is related to the business but not in terms of money. Those examples we are writing. So there is a strike by employees. Why is this related to the business? Because when the employees are on strike, my output will be less. So my business will not be working or it's not functioning. So it's a business transaction, but it's not in terms of money. So I cannot record this transaction. Another thing, a quarrel between employees. Again, it's a quarrel. It's a verbal communication. So it's going to affect my business, but I cannot record it. Another one, mm, hire or hiring of an employee. It's going to affect my business. My business will do better when I hire new employees, but it is not capable of being recorded until and unless I pay a salary. Until they are paid a salary. Okay. So that will take place normally after a month. So till then, this is not going to be written down. Okay. And if we talk of the common unit, the common unit is rupees. So if we just try and understand this, is the strike by an employee capable of being written in rupees? No. So it's not possible. Is the quarrel between the employees capable? No. Is the hiring of an employee capable? No. Again, these are all things which actually are taking place, but we cannot write them down because they are not in terms of money. Because the unit that we are supposed to use to write or to do accounting is rupees. And this is not fulfilled. Let's go to the next one. Accounting period concept. So this is which number? 6. Before we go there, we can also talk about something else which is there. Okay, so as I was saying, there are certain things that cannot, or certain limitations. You have certain limitations of money measurement concept. So, what are those limitations? The first is that transactions which are very important for a business, certain important transactions at times, so certain important transactions, at times you'll have certain important transactions are not possible to be written down in accounting. Okay. Another one is, let's say we have purchased an asset or change in the value of the currency. In our case, it's rupee. Rupee. Change in the value of currency has no effect. So this is bad because let's say you purchase, this is land. Okay, you purchase this land for, or let's say you purchase some building or machine. Machine is a better example. Let's say you purchase this machine for 10 lakhs. Now that is today. And after some years, let's say after 5 years, there is a fall in the value of the rupee. Change in the value of the currency has no effect. Let's say what was for 10 lakhs then, now it's like nothing. So now the value of this is the same machine, maybe an updated one, is going to cost me, it's going to become cheap. Whenever something comes out new in the market, what happens? It's always expensive, right? But after some time, it reduces. So let's say this machine was costing 10 lakhs, and after 5 years, the same machine, an updated one of this, is costing 5 lakh. So what is happening here is we are also considering the fact that the currency value has changed. So what 1 rupee was costing, what 1 rupee's value was at this date, it's like 50 paisa a year. This is after 5 years. So what value 1 rupee had that time, now it is 50 paisa. It's become less. So in this case, it's going to not have any effect because the machine is the same, but its currency value has gone down. What I'm spending 5 lakh here, it's like spending half the amount. Okay. So that's why this is also another limitation of money measurement concept, that any change in the currency value is not going to have any effect. Okay, let's go to the next accounting period concept. I think this is the sixth, yeah. So this concept says that the life of a business is normally, I say normally because this is prescribed. The life of a business is normally divided into a period of 12 months, starting from the 1st of April and ending on 31st March of the next year. So the life of the business is normally divided into a period of 12 months, starting from 1st April and ending on 31st March of the next year. The actual profit of the business is really found out when the business is closed down. But a business can't wait till then to improve upon itself. So the business is to follow a 12 months cycle. Okay. So basically, the life is only divided into a period of 12 months, starting from 1st of April, ending on 31st March of the next year. The actual profits of the business are really found out when the business winds up, when it closes down. Because you can, at that point in time, tell what is your actual profit. You can say, okay, these many are the assets of your business which you could sell and which you could earn back some money. These are the liabilities which are pending, the remaining are paid off. So altogether, the best time to get the profit of the business is the winding up of the business. But we cannot wait till then. Every year we have to improve our business. So what will we do? We'll divide this into a period of 12 months. And every 12 months, we will calculate our profit and loss of the business. So the business follows this 12-month cycle. This is what this accounting period concept says. So that's all to it. Let's come on to the next one, which is cost concept or the historical cost concept. Okay. So the historical cost says means that an asset is to be recorded in the business at the price at which it is purchased. Okay, so an asset is to be recorded in the business at the price at which it is purchased. Any change in the market value will have no effect to what is already recorded. in the books of accounts. So basically, whatever asset you buy in the business, it is to be recorded and it is written down in the books at the price that you buy it at. At no point in time will you rub that out and put the current market value price. So the reason for this is that you have proof. What is the proof that you have? Reason is that you have proof of a bill that you have used to purchase these assets. So at no point in time can this be said as to why have you written this amount in this for this asset. So a bill is there. Bill acts as proof. And why don't we follow the market price or the market value? The reason for that is because on whose perception are you determining the market value? A person's perception, which could be any person. So instead of that, instead of just following blindly somebody's perception, you follow what is it being bought at. That is its historical cost. And this is called the historical cost concept. Again, there are certain drawbacks of this. So, what will be certain drawbacks? So, limitations. First, this will be not recorded for assets which nothing is paid. For example, if you have spoken of assets like, let's say, the knowledge of a person. This is an asset. Definitely. A person who's working in an organization has this kind of an thinking that he has a good amount of knowledge. So your business will definitely make progress. It will go up in value. But this knowledge is not quantifiable. Knowledge is not quantifiable. And therefore cannot be recorded. Okay. Even though this will be a valuable asset. So we'll stop over here. You can go through these and let's continue on this in another video. For now, we'll just put a halt at this place and be back again. So do like, share, and subscribe if you do like the video, and I'll see you soon. All the best.